In 2026, the American housing market has reached total gridlock. Homeowners with sub-3% loans are refusing to sell, while new buyers are priced out. This is the lock-in effect, a cycle of stagnation that has frozen inventory and dropped transaction volumes to their lowest levels in a decade. While this residential freeze captures headlines, the broader economy is facing a much larger systemic pressure point: the $1.26 trillion commercial real estate maturity wall. This chart shows the disparity between two eras of credit. On the left are massive commercial loans originated at near-zero rates. On the right is the amount of capital required to refinance those buildings at current rates. For many owners, the cost of debt now exceeds the income the property generates. This rate gap creates a mathematical certainty of default for properties as their loans come due, and refinancing remains out of reach. This debt trap is already visible in the physical world. Office vacancy rates in major cities have hit 25-year highs, leaving millions of square feet of modern workspace completely empty. Retail investors often view these conditions as a random failure of the market. However, institutional players are tracking this specific scenario using a mathematical framework that dates back 150 years. In 1875, an Ohio farmer named Samuel Benner published a study on the price rhythms of pig iron. Having lost his fortune in 1873, he searched for a repeating pattern in commodity data to forecast future financial crashes. At first glance, the price of 19th-century industrial iron seems to have no connection to the $1.26 trillion debt crisis facing modern real estate. But the two systems share the same mechanical DNA. Both 1875 iron foundries and modern skyscrapers require massive capital, depend on institutional lending, and have multi-year construction lags. They are highly sensitive to credit costs. When credit tightens and the supply of new loans drops, both systems experience a freeze in transactions, eventually leading to a collapse in the value of underlying assets. Benner discovered that he wasn't just tracking iron, he was measuring the mathematical rhythms of human debt and the institutional cycles that govern it. Benner's model is built on three distinct phases that repeat in set sequences: panic years, where markets liquidate; good times, where assets inflate; and hard times, where markets move sideways. This framework has accurately pinpointed every major economic shift of the last century. It mapped the 1929 crash, the 2001 dot-com collapse, and the 2008 housing crisis years before they happened. These panic nodes represent the moments when credit vanishes, and the market is forced into a mass liquidation of assets to cover existing debts. If we map today's 2026 data onto this cycle, we land squarely in the hard times phase. This is a period of maximum stagnation, defined by the low transaction volumes and inventory freezes we see in the current housing market. The $1.26 trillion maturity wall acts as the catalyst that ends this stagnation. As those loans come due between now and 2027, the pressure on the banking system forces the market to process the bad debt. The math of the debt wall and the timing of the Benner cycle both point to 2028. By that year, the bulk of the 2026-2027 defaults will have been liquidated, creating an inflection point where the market finally resets. This suggests the current market freeze is a temporary accumulation of pressure that must be released before the next phase of the cycle can begin. Navigating this timeline requires a three-phase strategy. Phase 1, through 2027, demands capital preservation, avoid over-leveraged positions, and maximize liquidity. Phase 2 begins as the 2028 pivot approaches. This is the acquisition window, where the liquidation of the $1.26 trillion debt wall allows investors to purchase assets at cycle bottom prices. Obsolete office buildings in metropolitan hubs are a primary target. With low acquisition costs, these structures can be converted into residential housing to meet the ongoing supply shortage. A secondary target is industrial real estate. These massive logistics hubs serve a structural economic role, making them uniquely resilient to shifts in consumer credit. Phase 3 covers 2028 through 2032. The market moves from stagnation into growth as interest rates normalize. Investors securing assets during the 2028 distress window capture full recovery. Those waiting for mainstream confirmation enter late, resulting in lower yields. Success in the Benner cycle depends on the structural discipline to hold dry powder while the market follows its predictable, mechanical rhythms.